Good morning. This is Arlan Suderman, Chief Commodities Economist at StoneX, with today's update to what's happening on a couple of different subjects as I come to you at a little after 9 a.m. on this Thursday, May 22nd. More news to discuss this morning as we look at the developments in the markets. But first, let's look at the update in the commodities. We're seeing more pressure again on the energy markets as they continue to trade right around those break-even levels for the shale oil fields. Really worries about building supplies right now and softening demand, weighing on these markets. And of course, the more we see prices fall, the more pressure we put to shut down production in the shale oil fields at a time when OPEC is increasing production. So, in essence, we're shifting global market share from the United States to OPEC countries right now in this current dynamic. What we really need in the energy market is confidence and growth in the economy, both domestically and globally. And for that, we need more trade deals, actual hard trade deals with major trading partners. And I think these major trading partners, to a great extent, are maximizing the leverage of the 90-day window. Obviously, they don't want the tariffs to go back to the reciprocal levels initially announced on April 2nd, but they know they have 90 days in order to reach a deal. And I think they're going to leverage that as much as they can in order to get as good a deal for themselves as what they can. Can't blame them for that. And so that leaves us in limbo land of the unknown. As we look at the grain and oilseeds, we've seen a lot of strength overall this week as really at the low prices we were at, a lot of end users said, well, at these low prices, upside risk is probably greater than downside risk. Not that it can't go down, but we're moving into a period of increased weather uncertainty when things can quickly happen, and also in a world of headline vulnerability. Why not add some coverage? And then you look at the speculative funds in wheat held massive short positions and made them very nervous, particularly with some potential weather problems developing in parts of the United States, but also in the Black Sea region, adding some concern. And that kind of then spurred some short covering in corn and soybeans as well, because as we move into the month of June, that's when weather becomes more of a headline for those markets. And many forecasters are calling for elevated risks for the central and western Midwest this year. So we'll talk more about that as that time comes, but it became a short covering rally more than a, hey, let's get long these commodities type of a thing. And today we're seeing a little bit more sellers having a willingness to step into that rally and that consolidation. Of course, the markets will be closed Monday for Memorial Day holiday. The headlines will continue. So some consolidation is in order. Now, let's talk about the news headlines for today. The first would be the House passage of President Trump's one big, beautiful bill, his budget bill, so to speak. Passed in the narrowest margins of one vote. That's all that's necessary, but it means things are pretty narrow. And now it moves to the Senate. The Senate has very different views on things than the House. Even though Republicans control both, it's a different nature of Republicans in the Senate than it is in the House. So the work is still considerable ahead, and we will likely have many headlines moving the markets and impacting sentiment on this. If they're going to get the extension of the Trump 1.0 tax cuts, they have to keep it on schedule. So far, they are on schedule. They have many more hurdles to go. Now, whether you like this bill or not depends on which side of the aisle you tend to lean. You either see this bill as extending the Trump tax cuts, or as Trump simply says, the biggest tax cuts in history. Well, it's simply extending the 1.0 tax cuts and adding a few more on for adding additional cuts for Social Security, no taxes on tips, etc. A few things like that. But overall, it's basically extending the tax cuts. There are spending cuts to the discretionary budget here, but those cuts are then added on back on for areas like border security, rebuilding the military, etc. So it ends up basically flat with where we have been. Now, that's still an improvement from where we had been, just these automatic big increases every year. But it does nothing really to reduce the budget deficit. That's Doge is doing some of that work, but Doge can't do enough without the help of Congress. Unfortunately, in a democracy, the strength of a democracy is people get what they want. The weakness of a democracy is people get what they want. And people tend to want what they want when they want it, and will pay for it later. So when is later? And that's kind of what Moody's had in mind when they cut our credit rating. Now, Wall Street kind of gave that a shrug and shrugged it off because Moody's was the last of the major credit rating agencies to reduce our credit rating. But it's still a longer term factor we have to deal with. Now, France has tried to deal with it unsuccessfully. Germany tried to deal with it unsuccessfully. Canada tried to deal with it unsuccessfully. We're right now looking at annual deficit of 6.7% of GDP. The only country that I can think of offhand right now currently that's able to deal with it is Argentina, where finally the younger voters got so fed up with 200% inflation, they said, cut our social programs, cut our benefits, just get our house in order. And President Milei is doing it, and they're experiencing a lot of pain. So the longer we wait to deal with this, the more the pain will be. Now, obviously, each party seems to really complain about deficit spending when they're not in power. But when they're in power, they don't have the political courage to do in a democracy what needs to be done because they get worried about being voted out of office. And so I've not been confident throughout this entire process that we would be able to do what needs to be done to get our house in order, because I don't think the political courage is there to do it right now, because the voters say they want it done, but they're not willing to pay the price. They want someone else to pay the price. So nonetheless, that's my opinion, and that seems to be the path that we're on. So that's moving forward. So let's talk about number 2 item, and that's the biofuels portion of this. Within this tax bill was the 45Z tax credit program, which is a part of the ag commodities, and supporting the ag commodities as being feedstocks for liquid biofuels. Again, this is an example of another one of those programs who wants to cut their program. Ironically, it was really kind of the only green program that didn't get cut to some extent. And so if we look at the 45Z and what came out of it, it basically continues these credits through 2031, but only for feedstocks originating in Canada, Mexico, and the United States. Now, the most significant part of the bill is perhaps an exclusion of the indirect land use credit penalty for the carbon intensity score calculation starting in 2026. What is indirect land use credits? I'll give an example. Right now, corn-based ethanol doesn't qualify as a feedstock for sustainable aviation fuel because the government assumes that if a bushel of corn is produced in the United States to make ethanol, that forces producers in Brazil to destroy rainforest. Now, that's the assumption. It's a pretty difficult one to prove, because there's close to 100 million acres of brushland in Brazil that can be converted to cropland without touching the rainforest. I'm not saying there hasn't been destruction in the rainforest, but producing corn ethanol out of corn in the United States doesn't push the farmer in Brazil to destroy the rainforest. And is that the responsibility of the farmer in America when there is brushland that can be converted and is being converted in Brazil at a rapid pace? That's the debate. And in this bill, they remove that penalty. Now, that's a massive change, and that does push ethanol to qualify for sustainable aviation fuel, and is a dramatic improvement for demand for ethanol going forward. Of course, all of this has to survive negotiations now in the Senate, and so that could still all change in that process. Now, we still have to worry about what the final mandated RVOs will be, the renewable volumetric obligations, the production mandates. What are they going to be? There's all kinds of rumors out there what they may be. What will the small refinery exemptions be? You could have a very high production mandate and a very high exemption number, and that may be worse than having a smaller production mandate and a very low exemption number. Where they are, there are rumors all over the place. This is going to be very volatile over the next couple of weeks, probably moving the market in big swings as the various rumors hit. But we are moving forward with at least what I said in the bill in the House. Now we'll see what happens in the Senate going forward. So, regardless, I did want to update you on those factors. We'll try to keep you updated on what's going on in that regard. But these are the factors that are impacting the markets today. We are seeing some consolidation ahead of the 3-day holiday weekend. Once again, when the headlines are expected to continue to flow, but the markets are closed on Monday for the 3-day holiday weekend. So happy trading, and we'll be back with you again as the news break.